Good evening, everyone. This is Rodney with the Triton Wave Market Outlook for Monday, April 8th, 2013. All right, it is 8 o'clock, just before 8 o'clock, Sunday evening, Central Time. And it is Sunday, April 7th. I hope you all had a great weekend. I'm looking at the chart here on the left on the ES. I will expand that for your view, for your viewing pleasure. All right. I've been talking about the peaks and the non-confirmations between this run here and this run here. Whoops, and this run here. Okay, and I've also been talking about the higher highs that took place in these two runs and the lower highs that took place in the waves. T1 and let's scrunch this up a little bit. Let me see. And T2, just barely T2. T2 is not quite straight across. It's a little bit biased to the downside, but this is definitely the trading wave right here. And this has been going down. I've been talking about this going down for the last 10 trading days. While this is going sideways, a little bit down, a little bit up, a little bit sideways. Okay, well, this is what happened here. Friday, right at that spot. I told you back in last Sunday that it was only a matter of a few days before this went below zero. It did go below zero on Friday. Now Sunday with the open of trade, the ES is down below again, so that's 2 days in a row. That is definitely a sell signal. Let's expand this out and see what this looks like. This has already been up. It already started to challenge the 8-period moving average and is moving right at the 21-period moving average. So we are in a sell signal. It does not mean that this can't go down and pop back. It doesn't mean it can't go down and then pop back up again, which it probably will because everybody's buying the dips until they sell the retracements. So right now we're seeing down 2 days in a row, which means that this is going to make a major attempt to come down. Okay, this is going to continue down. This is going to continue down all the way across. This is slightly moving to the downside on T5. So if you are not already in it and there's a big blowdown on Monday, then just wait till it comes back up and hits the 8-period, hits the 21. Oops, wrong thing here. If you're lucky enough to get into here, that's great. If it comes down, don't chase it. Wait till it comes back up to the 8-period moving average. All right, let's look at a smaller graph here. 4 entry points. I'm going to move this back. Actually, while this is open, I want to see what the weekly looks like because I haven't looked at that for a long time. Okay, I just to make a note, I want to show you how extensive these wave formations are because they don't even fill up. It doesn't even fill up the graph going back just barely 2 years on T5, and that's with 15, 16 years worth of data. And I'm only getting like a year's worth filled in on. So this is to tell you how extensive the wave incorporation is. It's not just going back and looking at and looking at segments like this or like this. That in order to get a reading down here, I'm incorporating what's going on back here. So this is like long-term behavioral patterns. So when it starts going below zero on T1 on the daily, heads up, because it goes back a long time in time. It's not just something that just like that happened out of the blue. All right, on the weekly, the only thing that I get here on the weekly, looking at it, is these are obviously higher highs going all the way back to the beginning of 2012. The only thing I get here is this is a higher high, so it's in sync with these higher highs, except this is a lower high right here than this one, and this is a higher high. So that's definitely a red flag on a weekly basis, and it doesn't have to be below zero on the weekly to take it. All you need is a non-confirmation, because obviously, if you waited for the weekly to happen back in the middle of 2011, back in July and August, the weekly went down below zero here, and you already missed 2/3 of the move. So you don't have to wait for T1 to go down below zero on the weekly. On the daily, however, good time to get in. Very, very good time to get in. Now on the daily, I have the, okay, this, I was showing you, oh, that was another video that I did, so I'll just recap really quickly here. This is the 8, 21, 55. If you have the programming ability to do this, I know that you cannot do this on Thinkorswim, and you can't do it on a lot of formats, but if you have eSignal or you have TradeStation, you can do this. So if you want to just follow these lines, these are good entry and exit points. 89, 144, 233, 377, 610, 987, and 1597. They are all exponential moving averages, and I suggest that you have a lot of gigabyte space to do this, or else your system is going to crash. So don't put these large numbers in unless you have the capacity to do it, because then you'll be emailing me and telling me that, asking me why it didn't work. All right, so let's look at a 1597 here. 1597 tick chart to see when a good entrance on the daily is going to be, because we've already established that this is below zero here. Actually, what I wanted to also show you was that the gap between the 8 and the 21 is rapidly disappearing, and it wouldn't take very much for that to come back down again. However, by the time it comes down, we could easily be at 1521 on the S&Ps. All right. On the right-hand chart, we see a move on T1. It starts moving up. This is Friday. This is Friday. This is Thursday. Plenty of short-term plays here. You're playing this basically as long as this major wave is above zero. You can play this to the upside. Well, actually, it's above and below, so you can play both sides of it. Then you can see entry points here, right in here. You got this nice ride all the way down. Right in here, you got this nice ride. And if you're following T1 and it was driving you crazy because you're in and out too much, then you just go to the longer waves. You won't get as clean entries. I mean, you get a cleaner entry, but it'll be like at a lower price. But at least you don't have to worry about you know, like watching it every single second of the day. So the cleanest entries here was T3 that got you in right about here, and you covered and went long right about near the bottom, so a few points off the bottom, and then you rode it all the way up here. So right now I am looking this this movement into the close. It was down 170 points on the Dow on Friday, and it closed down, I believe, let me see here, closed down 40, but the S&Ps were still down 750 after being down almost 20. So, or 2,000. So I'm looking for this to. This is actually a live chart. Let's see how far we were up. We're up to 1548, and now it's 1548.75. So it's 275 off the low, and we're flat. As we speak, we're flat. So it started on the upside, and you can see we're starting to roll over a little bit. T1 is going below 0, and T2, we have to wait and see whether that follows. But most important, we have to see if T3 and T4 follow. So one of the things I've been looking at is, let me bring this graph over here, is the Aussie yen cross and the euro US dollar. So this is a daily chart, and you can see from, let me see if I can move this over here a little bit and keep them both on the chart at the same time. Okay, so this will only the tracking device here will only work for actually, let me see if I can get an arrow on this. Okay, well, it's a little, let me make it a different color here. Red. Let's see if that works here, that works there, and it works here. Okay, so the heavier line, the Aussie dollar against the Japanese yen is are these thick candles right here, and the Euro USD are the thinner ones. All right, so let's look at this. So the Aussie dollar, there was a Japanese intervention of, you're not going to believe this if you haven't been following the news, one Bank of Japan on Wednesday evening did a quantitative easing with an influx of $1.5 trillion. That's U.S. dollars over a 1.5 year period. Okay, that is the same that the United States is doing, but the difference is that Japan's economy is 1/3 the size of the United States, which means that the stimulus that Japan is giving to their economy after 20 years of deflation is 3 times the stimulus that Bernanke even dreamed of doing in the United States. So as a result, the Aussie went spiking up. Oops, I got the wrong thing here. The Aussie went spiking up in the last 3 days, and of course I don't have the chart here, but the yen went like down to hell. It really like collapsed. So the difference in all the past, I could pull up a graph here, but I've done it so many times in the past that they are on other videos that I've done for the past 7 months. They're on a lot of videos. And that was a comparison that I did. I did a something called an analysis of the what I call the Ben Draghi crown, which was Ben Bernanke and Mario Draghi, where every time they did a major influx of cash, in other words, QE, Infinity 1, Infinity 2, Infinity 3, whatever the hell you want to call it, and there was a huge spike in there was a huge spike in the stock market. And then when Japan tried it, there was a minimum spike. When China tried it, there was no spike. It started going down again. And every time they tried it, it produced this crown. I think there's a January recording, January 2nd or 3rd recording that explains all that. So my point of all this went up, spiked up the Japanese stock market by 5%. And what happened to the U.S.? Okay, let's look at the U.S. over here. The U.S. went down, sideways, and down. So there was not only no reaction, there was not only not a reaction to the upside, there was a negative reaction. So what I'm trying to tell you is these correlation indexes that have been in place for a really, really long time. You know, like when the Aussie dollar goes up, that means there's buying. When the yen goes, when the Aussie goes up, there's risk on. When the Aussie dollar goes down, there's risk off. Okay, so let's look. So when the Aussie dollar is going up here, obviously Aussie's going up, yen's going down. I don't have a pen, or else I'd write in JPN, but or JPY for yen. So the correlative indexes that would say that when the Aussie dollar goes up, then risk is on. That means the stock market is going on, has completely been shot to hell, because what happened was our markets in fact went down. The bond market went up. The euro, which is here, even that went up, and our stock market went down. So that's like one strike here, and the strike against the euro is 2, and I'm sure there's a 3 in there somewhere. So the problem with all this is that people have been buying the stock market for a really, really long time because it's the only game in town. Well, Mark Faber, who is I think he lives in Singapore, billionaire investor. He said, when you are the only game in town, it ends badly. So the only game in town right now is the U.S. market, and it's not because we're performing so well, because we have like our QE infinity is just as bad as everybody else's and maybe worse. But the fact that we're the least bad of all the other places. Well, you know, so were tulips in the 16th century, and they went from, you know, like 25 cents up to 50,000, and everybody thought it was great until they were back to 50 cents again, and everybody lost their shirt. Which brings me to the point that 92% of all financial wealth is owned by 5% of the population. So if indeed the S&Ps start moving in a downward direction, and we get something that looks like this, that wealth effect is going to really disappear. And these 401ks are going to turn into a 201k, and the wealthy, who supposedly are inspiring our economy right now with all the influx of the QE money, they are going to lose 20 to 30% of their wealth, if not, in some instances, their life. Okay, I have one other point to make here, and then I'm going to look at some stocks. And that is, when they were looking at stimulus programs in 2009, there was the government sat down with some analysts and decided that the projection of stimulus growth was that for every dollar of stimulus, it had a 1.54 multiplier. That means we were getting like 50% more growth than it was costing us for the amount of stimulation that we were putting back into the economy. 1 month later, that was revised to a break even. $1 stimulus, $1 multiplier, a multiplier of 1. In 2011, which was 2 years ago, $1 for every dollar of stimulus, the multiplier is 0.46. Ladies and gentlemen, we are going downhill, and the sooner you realize it, then you just have to protect yourself. So instead of buying the dip, you're going to have to start looking at it the other way. Just reverse. Basically, you see this area right in here? Every time it hiccups to the upside, that's when you're shorting it. So you're shorting all the rallies instead of buying all the dips. And that's the way that I'm going to be looking at it for the next several months. All right, the market is not going to move without Apple. Apple is moving down, and on the left-hand chart here, it came back up. It rallied from 421 in a 2-week period up to 465. Hit the 55 period moving average, and then came back and matched the lows of about 1419 on Friday. So it looks like on the 21-minute chart, which is a cash price chart, it looks like it may want to move up. I'm looking at this, and unless Monday opens and this just goes down, then it looks like this wants to move up. These want to move up just a little bit and recover some of this, probably, like either for the next, if there is an upside target here, it would be 426, 430, and then 434. But if I'm looking at what's going on the left-hand chart, on the daily, it looks like 434 and 441 would be wonderful shorting opportunities. It does look like Apple is above zero here on the daily, so you have to be careful if you short it. You want to go to a daily chart. I'm sorry, not a daily chart, a 610 tick chart, and play it like that. These are by far the best trades. Let me just block this off here. Okay, here's 3 days of trading on Apple, and you can see that this is Friday, Thursday, Wednesday, and Tuesday, and most of this is Tuesday. It ends right about here. But you can see that this 610 chart, when this went below zero here, this move was from about 436 down to 427. Nice move for a daily move. And you can play it on the upside, ride it overnight, wait till it comes back the next time. And you don't always get these really, really clear signs, like these nice wave patterns like this. But when you get them, you take advantage of them. Because most of the time, a lot of times it's just going to drivel sideways down like this, and it's going to make the wave patterns look a little funky. So then you have to go to a bigger wave pattern, and instead of looking at the 610, you have to look at the 987, and the 987 is, okay, that's just completely below zero on the anchor wave. It's below zero here. This is just starting to pick up a little bit. So it may move, it looks like it may want to kick up a little bit back to this 1441 area. If it does, that would be a good short. All right, let's look at one more, and I'm going to call it a night. Okay, one more. Let's look at Goldman Sachs, my other favorite stock to trade. I had a target of 141.16. It hit it, went just slightly below 140 to like 140.20, Let me see here. Hang on. 140.34. So it went a little bit below, but the target was from way up here. It was a 5-point target. It hit it. I waited a little bit to see what the 144 tick chart was going to do, because this I like the 144 and the 610. So this is right here. Whoops. All right, that's the trading on Friday. So I waited for the dip. It did come down here. I didn't take it, and then when it finally, I didn't take T2, but I did take T3 when it went up here, and right in there, which was here. So I missed a couple points off the bottom, but I basically got it from here. Instead of getting it from here to here, I got it from here to here. And then it basically saved me from losing the entire thing when it ran all the way back up at the end of the day, because then I would have ended up getting in here, and you see I would have lost. The arrow's going up. So we did make a nice profit there. I'm waiting actually for this to go back up to possibly hit, not that I'm looking for the market to go up, but I'm actually looking for a move back up to this area of possibly a Monday morning spike to 145.24, which would get you back in on the downside, because all of these waves look down. Down, 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 down. Well, these are heading down, but T1 and T2 are the trading waves, and T3 is even following through. All right, that's all I have for tonight. I hope to see you at the next update. I wish you well on your trading. Just to let you know, I'm sure you've heard this 100 times already, but I will tell you that I was lucky enough to be cited by the National Association of Day Traders, who cited me for having like a major new trading tool, which was very flattering. And I also do, although I don't give public advice on gold and silver, I do it for private clients. So if you want to get in touch with me, I am Rodney Julian at TritonWaveGuide.com. I'm sorry, messed that up completely. TritonWaveGuy@gmail.com. I will see you at the next update, and good luck trading, and have a great week.